How does the bond market fund the farm credit system? Imagine a network that helps farmers, ranchers, and rural communities get the money they need to grow crops, buy land, or build homes. That's what the farm credit system does, and the bond market is its main source of funding. But how does that actually work? Let's break it down step by step. The farm credit system raises money by issuing debt securities, like bonds and notes, through the Federal Farm Credit Bank's Funding Corporation. This corporation acts as the main agent, managing the sale of these bonds on behalf of the farm credit banks. These banks are AgFirst, Agribank, CoBank, and the Farm Credit Bank of Texas. When they need funds, they turn to the bond market and issue bonds that investors buy. These bonds are considered very safe because they are rated high by credit agencies, often at AA+ or similar ratings. Investors include big institutions like pension funds and insurance companies, as well as individual investors. They buy these bonds because they offer steady interest payments over periods that can range from 1 year up to 30 years. The money raised from selling these bonds doesn't go into a bank's vault. Instead, it flows directly into the farm credit system as funds that can be loaned out. The funds are first received by the farm credit banks, which then distribute the money to local cooperative associations. These associations are owned by farmers and rural residents, and they lend money directly to farmers for buying land, equipment, or funding operations. When farmers repay their loans with interest, the associations send that money back to the banks. The banks then pay interest and principal to the funding corporation, which in turn makes payments to the bond investors. To keep investors confident, the Farm Credit System Insurance Corporation, a government-controlled entity, ensures the timely payment of interest and principal on these bonds. This insurance helps make the bonds more attractive, even though they are not directly guaranteed by the U.S. government. The entire process creates a steady flow of capital that supports farmland purchases and rural development. Because the system is structured as a cooperative owned by the borrowers, it aligns the interests of farmers with the financial health of the system. This setup ensures that the farm credit system can meet the ongoing financing needs of rural America. For farmland investors, understanding this process is key. It shows how the availability of long-term, stable funding helps keep farmland values steady and supports agricultural growth. So, in simple terms, the bond market funds the farm credit system by providing the capital through the sale of bonds. This money then helps farmers and rural communities thrive, making it a vital part of the agricultural economy.